Why is venture capital coming here? Because they're making money, okay? Thank you and welcome to all of you. My job is to set the stage a bit for the next 2 days. Ami talked about making impact. For lack of a better term, the theme I'm going to talk about is probably making money. Because that's what you're here for as well, right? I'm going to cover 4 areas, really starting with the venture capital environment, talk a bit about the Israel ecosystem, changes at OurCrowd, and then OurCrowd going forward. Legal disclaimer, of course, we're talking about making money. Past performance is not indicative of future results. So the beginning of a new decade is a great time to have a historical perspective. So let's talk about value creation in the last 40 years. I've been on Wall Street since the mid-'80s. And I'd like to pose the question, what has created more value than the semiconductor and digital revolution over the last 40 years? There's one thing that's created more wealth. It's called the decline in interest rates. Decline in interest rates has created more wealth because it creates multiple expansion. The PE multiples of revenue on companies go up when interest rates go down. And it has quantitatively created more wealth. Guess what? That can't happen again. You can't mathematically have that occur again. So going forward, not backwards, going forward, you have to think about growth. It's more critical than ever. One of the 2 biggest changes. Second big change in the last 40 years is what's happened to the IPO market, the public markets. What you see on here on the left, pre-bubble, pre-internet bubble, Apple, Microsoft, Oracle, Amazon going public at $1 billion or less, that's that little blue you can barely see. Then you see in the green what the return has been. Yes, granted, these are the great winners, but 1,000, 2,000 times your money. 100 times would be fine for me on most of my investments. On the right, you see Google, Facebook, Twitter. Suddenly, the values that go public are 20, 40, 80, Uber, $80 billion when they're going public. And the returns, a fraction. In fact, if you invested in every IPO last year, you lost money. Triton Research has put that data out. So 2 great changes in the market. And so what's happened? Global venture capital funding is growing. The punchline is you've got to be investing pre-public. And that's why more money is going into venture capital. We did see a decline in 2019 entirely due to a reduction in investment in China. Now, this is not lost on the smart money out there. These 2 big changes, the focus on growth, the need to be pre-public. By the way, most companies don't even go public. Most of them are sold in an M&A transaction. That's where the realization is. So I've put up here the Yale endowment model. Yale has created an endowment model based on their success as the most successful, the highest return endowment the last 35 years. They created a whole new model that many other endowments follow, allocating a great deal towards illiquid assets. 8 categories. Look at venture capital in red here. Not only is the target for the current fiscal year 21.5%, look at the change in the last 6 years, from 13.5%. Often people are stunned at over 20% of a $30 billion endowment. Not suggesting individuals or even smaller institutions should be at that number per se, but it's astounding of what the smart money is doing here. So let's talk about the Israel tech ecosystem. You heard Ami referencing the increase in venture capital, basically a quadrupling over the last decade. Quadruple again in the 2020s, that takes you to $30-some-odd billion of venture capital. We'll see if it occurs. Why is venture capital coming here? Because they're making money. Okay, you're investing in companies. We're seeing the realizations through exits growing on a trended base. We certainly see certain elephant-type deals that distort the numbers, but you get the picture of the trend here. So what are we doing at OurCrowd to capitalize on this, help our investors make money through venture capital? We've created an empowering, flexible model that's not one size fits all. It's not, yes, we offer funds which are more traditional, but we allow you to invest in individual companies. We allow you to invest on rules basis, you name it. That's why we ourselves are a fintech company. And in 6 years, we've gone from a startup, we're still a startup in many ways, or a scale-up, but from starting to being the most active venture investor in Israel the last 2 years running, and we think probably we'll maintain that leadership this year as well. Again, according to PitchBook, the authority on this. And what you see here are some of our highlights. We invested in 38 new companies last year, and we like to highlight, for those of you who come at the venture investing world and say, I want exposure to the category, the extreme diversification that we offer. In fact, it's hard to find a category we don't invest in. I'm often asked that, and the one I point to is cryptocurrency, because we just don't feel we can catch lightning in a bottle. But tremendous diversification here. You see the stats on the bottom. We just crossed $1.4 billion of committed fund. We've vetted over 10,000 companies. Our ratio of a company that comes to us that will invest in is about 1 in 60, 1 in 70, so sub 2%. 200 portfolio companies, 20 funds. You see the rest of the numbers. We crossed 41,000 registered accredited investors recently, and we're adding about 1,000 or so a month, hopefully with the summit. This will be a particularly good month. And we're diversifying a bit on the source of our transactions. And this we recognize is controversial to some extent sometimes within our investor base. We believe, an unfair competitive advantage in Israel. This is where the vast majority of our deals are, but we are sourcing deals from elsewhere in the world. But we're doing it in a systematic way where we're leveraging our network. I was asked in Miami at a conference 2 weeks ago, well, what are you doing to compete with the folks in Silicon Valley? I said, well, we can't point to a competitive advantage in Silicon Valley deals. We're competing with them by playing to our strengths and where we can source transactions. And you see the growth in the value of companies in our portfolio. Now 64 companies above 100 million in valuation. We are doing some late-stage investing, but the vast majority of those we invested when they were well below 100 and have grown into this type of valuation. And what you also see, updating you, are some of the exits. We had 8 exits last year. Again, cross-industry. I won't read each of them. But we're thrilled particularly to participate in the Beyond Meat IPO, the most successful IPO of the last 10 years in the food tech world. Last year, I know we created gridlock here by offering free Beyond Burgers. We're not going to do that again this year, I don't think. So target sectors. One can't talk, back to the historical perspective, you can't talk about the 2020s without talking about AI. 25 years ago, every company in every industry should have been asking itself, and the smart boards were asking their management teams, what's your internet strategy? A quarter century later, the analog is, what's your AI strategy? You have to think about your AI strategy. AI, I believe, will be to the 2020s what electrification was to the roaring 20s a century ago, because it can be applied everywhere, which I'll demonstrate in a moment. So here you see data from Forbes quantifying AI startups. United States, no surprise, that's the leading place. But then you see China and Israel going neck and neck for number 2. There are fewer people in Israel than in most major Chinese cities. Extraordinary, and ahead of the UK. So setting the stage on AI, I want to talk about 5 different sectors, back to this diversification theme that we're in, highlighting specifically that we've been very focused and will continue to expand that focus on companies that are employing AI or helping be vendors that address solutions in different industries leveraging AI technology. So first in fintech, Lemonade in the insurance tech world, BioCatch just launched our 4th round on the platform in the past week, behavioral biometrics, Theta Ray, in the banking security space is their biggest use case. It's a cybersecurity company, but the greatest use case is in the banking world. Cybersecurity itself, Canna Perception Point, and SixSkill. Turn to mobility, an area which is exploding within the Israeli ecosystem. Cardica, Halo are chips, but focus primarily on mobility, ride vision. People often call that Mobileye for motorcycles. Faculty people came out of Mobileye. That's what happens in an ecosystem when there's a great exit. Restless engineers and executives want to be part of a new company, and so they often start their own. And then agritech, Taranis, Tevel, and Cropex to highlight here. And then finally, in the healthcare world, Site Diagnostics, the anti-Theranos, as Forbes has called it, that has the two drop of blood CBC count, Zebra technology in cancer detection using AI to assist radiologists, not replace them, assist, and then MetaWare. And so as we develop and expand the platform, we're also going through our own changes to broaden our portfolio and to expand our distribution. And this is what led to a real seminal new relationship for us this past fall. We received a strategic investment from Stifel Financial in the U.S., the 7th largest brokerage network. We have many people from Stifel who will be here. They're already here, frankly, but will be speaking in the next 2 days, giving us access to over 2,000 financial advisors. They have 300 billion of AUMs. This will help broaden our distribution of the funds and individual companies that we are now offering. And here you see that we'll be distributing both individual deals and funds through that network. It's a relationship that we're very excited about, and it's just the next step in the evolution of the platform and our institutional relationships. So hopefully I've set the stage for you for the remainder of today and into tomorrow. And with that, I'll turn it back over to Alan to introduce our first panel. Thank you very much.